As the regional bank turmoil continues and markets digest the Federal Reserve's latest rate hike, investors and executives are turning to the next big question. What if lawmakers fail to resolve the standoff around the U.S. debt ceiling? That scenario, though considered unlikely by many, is attracting attention as the outlook for the economy darkens. With ongoing pressures on smaller lenders, slowing growth, and rising financing costs, they're wrangling over increasing the $31.4 trillion statutory limit could roil markets further. President Joe Biden has invited congressional leaders for a May 9th meeting after Treasury Secretary Janet Yellen suggested that the so-called next date, after which the U.S. might exhaust the options to fund itself, could come as early as June 1st, less than a month away. Bank analysts and ratings firms are forecasting a substantial hit to credit markets, depending on how long the political standoff lasts and how it ends. Bank of America Corp. Analysts expect market stress around the borrowing limit to build in the coming weeks, potentially resulting in risk-off sentiment among investors. Treasury bill markets already showing significant signs of worry around the potential for non-payment of U.S. debts in early June. The bill curve now shows a more pronounced hump the first week of June. Bank of America analyst Mark Cabana, Katie Craig, and Ralph Axelrod in the May's four-note to clients. Market participants will likely revise their forecasts and models in the coming weeks as the date nears. Traders are weighing a range of scenarios, including a suspension or temporary extension of the limit. But even if there is an agreement to raise the ceiling before the cutoff date, there will be an impact on vulnerable issuers, especially if there are cuts to government spending. Moody's Investor Service said, we see the debt ceiling as a tactical risk to our more bullish call on spreads. Analysts at credit sites Meter wrote, pointing to previous standoffs are caused spreads to widen even after they were resolved. 7 asset owners already appear to be preparing for spreads to move out. U.S. jump bond funds saw $1.58 billion in outflows during the week, ended May 3rd, while investment-grade funds added $321.6 million, according to Refinitiv Lipper. A missed interest payment in a no-deal scenario would cause a downgrade in the U.S. AAA rating and have widespread rating impacts on government-sponsored enterprises such as Fannie Mae, Freddie Mac, and the Federal Home Loan Bank System, as well as not-for-profit hospitals and public entities. Moody's said wider knock-on effects on banks, insurers, clearinghouses, bond funds, and money markets are also expected. The ratings firm said, pointing to the risk of elevated redemptions, which would put pressure on liquidity. High-quality investment-grade rated bonds, however, could become more appealing compared with other asset classes as investors seek safe havens. Those names will likely see little to no credit impact, according to Moody's. Investment-grade credit spreads stood at 146 basis points, more than Treasuries on Friday, up from 138 basis points on May 1st, while high-yield spreads rose to 471 basis points, up from 439 basis points on May 1st. Corporate executives so far have said they remain confident that lawmakers will figure out a solution for the issue around the debt ceiling. I do think it will resolve itself, but there'll be a lot of noise up until that occurs, said Kevin Chrysler, the finance chief of Pure Storage Incorporated, a data storage firm, echoing comments on other company leaders. KWG Group became the latest Chinese builder to default on yuan-denominated borrowings, sending its shares and dollar bonds to a record decline. The default could continue to test the shaky liquidity of KWG's developer peers, according to Bloomberg intelligence analyst Christy Hung. An affiliate of Chinese developer Sino-Ocean Group is proposing to extend a coupon due in April to October. Another Chinese developer, Wilden Group, shared fresh details with some creditors about a possible offshore debt restructuring proposal that could include a debt-to-equity swap option, Bloomberg News reported. Adani Transmission Limited, part of Indian billionaire Gautam Adani's conglomerate, plans to buy back as much as $100 million of bonds issued by a unit in an effort to boost investor confidence, PR Sanjay and Saikat Das reported. Holders of about 86% of eligible bonds from WeWork Inc. agreed to swap their notes for new debt and equity. As the office-sharing company looks to cut debt to move toward profitability. Europe's technology, media, and telecommunications companies are set to struggle when it comes to refinancing after several years of heavy investments swelled debt loads in the sector, according to research by Boston Consulting Group. The firm highlighted TMT, along with leisure and tourism, as industries that will find it most difficult to refinance in an environment of high